All right, let's talk about the answers to the price to earnings valuation methodology exercise. Let me zoom in because my eyes are not that good anymore. The older I get, the better I was. Okay, cool. Shift, click, finger off shift, delete. Here we go. Okay, so the growth year over year for EPS is 65%, right? It's just that growth over that. And this is pulled directly off the income statement. Okay, it's down there, bottom right. Okay. 65% earnings growth, and earnings growth slows to 54% earnings growth. Okay, so in terms of the price target for that year, what you do is you double click, and because we're at 2 times the earnings growth rate, we're in a bullish market there. I don't like 2 times earnings. I prefer to pay closer to 1 times earnings. But we're in a bullish stock market environment. Everything's going up, even the low quality, high growth stuff. Okay, so in this case, what you do is the PE is going to be twice the growth rate. Well, the growth rate's 65%, right? So the PE is going to be very, very high. So here's what you do. You take 2 times that red one there, okay? So that basically means a growth rate of 65% times 2 is 130, okay? Times 100, just get rid of the percent, put in real numbers. And then you multiply it by earnings per share that year. That'll get your target price, and your market cap that year is just that times the number of shares at the bottom of the income statement, okay? Okay, that's expensive. And by the same token, you do the same thing here, except the growth rate is lower. So we're going to take EPS in 2020, and then we're going to multiply it by 2 times the growth rate, right? So 108 or whatever it is. And the market cap is just that times the number of shares, okay? That's a bullish market, okay? That's when everything is going up. I don't like buying stuff at 2 times earnings. I like to short stuff that's 2 times or more, usually if the fundamentals, catalysts, and everything are all in alignment. Okay, bearish. What we do here is if the market's not doing well, or if somebody's bearish on this company for whatever it's worth, the price target can be 1 times the earnings growth rate, okay? And so in this case, you've got growth of close to 100% here, call it 99, okay? And then what you do is you're going to take this one, okay, times the growth rate, basically, right? Or 1 times the growth rate. And that's basically 100% growth. So it's like 100 times earnings. So your target price is about 100 times that, okay? And this one here, you got lower growth, okay? So it's going to be about 90 times, okay, earnings, okay? Still kind of expensive, but I don't mind paying up for growth, okay? And then my favorite is to look out 5 years and then discount it today. So this is the just right Goldilocks and 3 bears, okay? This is in between, okay? 1 to a 2 peg, okay? And shift, finger off shift, backspace, there we go. Okay, and here the price target is 1.5 times the growth rate, okay? So it's like 150. So you take that, okay, times 1.5, I should say, okay? And then you just find the PE, similar to what we did before. And then the same thing here, our last one, it's 1.5 times that growth rate times earnings there, okay? And that, whoops, that gets us to a target price of that one there. And then I like to discount by 4 or 5 years, depending where you are in the year or next year, whatever it is. I think you guys understand how DCF discounting works. And then that discount is the price target today, and that's a high price target. Okay, so you've got 3 answers here, okay? I'm glad we did the high price one because it will somewhat get normalized by this, right? So if you just use PE, right, you might decide, oh my God, that one is way off, right? And if you just use DCF, you might realize, oh, I'm not bullish enough. So some people might even choose to ignore that one because it's an outlier, okay? And 1 or 2 data points doesn't make a trend, but many do. So you might want to do another valuation methodology here if you wanted to, but I think this is good enough. And when you bring this to your portfolio manager, your boss, your potential employer, they might say, Chris, I kind of think this is an outlier. I don't want you to factor that in at all. And they'll get rid of it, okay? Or you might get to a point where you're a sophisticated investor and you just kind of look at one or two of these, right? And you might even favor this one here, but you better have good logic in your model to justify a target price of that much upside. I love looking at ridiculously high target price companies. I don't like wasting my time trying to come up with investment ideas that are going to go up 10% per year, right? Because the margin of error is just too high. What if you're 5 or 10 or 20% off, right? So this excites me, these types of target prices here, because basically I'm an outlier. There's no way anyone else in the market's going to think the stock's going to go up that much. And I love that. That's why I love looking out 5 years, because again, I don't know the path, but I know the destination if I feel comfortable with my 5-year estimates. And again, Wall Street or most analysts, most investors look out 1 year, maybe 2 max, whatever. I think the smart money looks out longer term. Okay, so anyway, here's a blended average of all three. Our target price is about a 9-bagger, close to a 10-bagger. It's pretty good. Pretty good. Okay, cool.